Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions tonight, Pierre Verster from Protea Capital Management, Mark Du Toit from Oystercatcher Investments. Remember to send your questions through via email to stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Gents, appreciate the time today. A ton of results coming through, a ton of questions coming through. Mark, let's start with you. Harmony buying into copper for about R1 billion. I got to say first, I love the Harmony Sense announcements. They fluff them up, they make them sound like great PR. The JSE might not approve of it, but your thought? I mean, I see what Harmony's doing. It's a different metal. It's a different, I suppose, sort of investment case to gold. Your take on the jump $1 billion into a copper acquisition?
Yes, well, I mean, we were expecting Harmony to continue with their strategy of diversifying away from gold and into more copper assets. As you all know, the gold price has been very strong of late, so they've had a lot of cash sitting on their balance sheet, and they've been looking to deploy that into new mining opportunities. I mean, I think that it's difficult to find existing mining operations for a reasonable price. So, I mean, they paid at about a 10% free cash flow yield for this asset, which is not crazy. So I think it's reasonable, and it is operating already. So that also removes a lot of the risk. I guess the only drawback is when you invest in a mining stock, you kind of have to make peace with the fact that those cash flows never seem to return to shareholders and always get invested in a new venture. But Harmony has kind of maintained about a 4% dividend yield over time, so we'll be thankful for that. But yeah, it'll be interesting to see actually whether investors want to own a copper gold business, because typically you would add gold shares to your portfolio for a specific reason. And I'm not sure that the gold and copper together, I'm not sure that they're going to get a premium rating for that kind of mixture of assets.
Yeah, and that's exactly my thought. You buy a gold miner because gold is running and you want the leverage. I'm not sure I want copper there. Pierre, your thoughts? I mean, sure, certainly there's a good story for copper. Gold is a little weaker today, but it's still above $3,000, comfortably so. But I like Mark's point that what we start to see is the gold miners, while they're printing cash, they go and spend it rather than give it to shareholders.
Indeed. I broadly agree with Mark. What I would say is I much prefer Harmony buying a copper mine in the current environment versus going and buying another gold mine. I wouldn't be happy with that, because the gold price and all the dynamics do seem to be a bit toppish, if I put it that way. So gold and copper are very often found and mined together, and then the copper is quite often seen as a byproduct metal. But this is a proper copper mine. It's in a stable regime as well in Australia with a long life of mine. So yes, I agree again that I would have preferred to have the cash in my pocket. Shareholders might have preferred to have the cash paid out, but also rather diversify in a mine based on a metal which isn't currently in a bubble versus buying another gold mine or hedging your gold price. Ooh. Because the moment gold mines try to decrease their risk by doing that, they invariably get it wrong. So, there are least worst outcomes for Harmony shareholders, I would say. Least
worst. Hedging, AngloGold Ashanti springs to mind, and then buying gold mines, well, AngloGold Ashanti springs to mind. Yes, we're looking at you, AngloGold. Pierre, let's stay with you. Coronation results out today. Not a bad set of numbers, nice dividend. I think largely what we were expecting. Question coming through, and the question is, I hold 91. A lot of the panelists have liked 91, particularly in a strong market. Should I be having a look at Coronation? Would you look at Coronation over 91, or perhaps it's a sector you're not particularly thrilled with?
I mildly like both. So they might not be at the top of my buying list, but we know the business model. Mark and I are in the same business, it's asset management. So we understand the leverage that can come from that. If you have a team of analysts, people managing the money, every incremental rand that comes into the funds really improves your leverage and can magnify the growth in your bottom line. But that has been the problem for these illicit asset managers of late. There has not been money coming into the funds. They have seen net outflows, and particularly Coronation. because it's more a South African asset manager versus 91, which is a global asset manager. So with 91 really having years of headwinds now, our savings industry is shrinking because we have more people retiring than people entering the job market. That is not a good environment for a large asset manager. So I do like both. I don't have a strong preference between the two, maybe a slight preference for 91 because it is more global and more diversified. But I don't see any of these two businesses or shares shooting the lights out in the next few years.
Yeah, and Mark, maybe they're not going to shoot the lights out. Rising markets does help because it increases ORM and they get a little bit more fee. Have you got a preference between Coronation or 91?
Well, we own 91. We don't own any Coronation, so I guess definitely have a preference for N91. I guess the global reach and the mix between equity and fixed income, and also a better distribution business that N91 has. So yeah, that's our preference.
A lot of questions coming through around ASP Isotopes. It was a stock I hadn't heard of until a couple of weeks ago when they announced they were going to be listing on the JSE. They've now potentially going to be buying out Renogen and delisting Renogen from the JSE. Mark, I mean, I got to say, my sense is that I'd liked Renogen, but they haven't got their phase 2 going. They haven't got phase 1 at full nameplate capacity yet. And this really, I'm not sure. I look at the ASP Isotope and Renogen. I'm not sure I'm excited about what there is. Have you got perhaps deeper insights into ASP Isotope? Are you excited for the deal or not at all?
Yeah, so it's not a company that I'd actually heard of it before, but not a company that I've looked at in detail. I still can't quite work out exactly what their business is. So, I mean, I don't understand what the enrichment, of these metals, kind of is. It seems that they've been able to raise some capital based on their CEO's knowledge and plans for the future, and they've used some of that capital to now potentially fund Renogen's expansion. So yeah, I mean, it's not a business that I'm looking at with any intent.
Jean-Pierre, have you got a deeper insight?
I did read through ASP Isotopes 10K about a week ago. Mm-hmm. That's the panel report they lodged with the SEC, the Securities and Exchange Commission, about a month or two ago. And basically, this is a pre-revenue opportunity.
Yes.
This is a very early stage company. They've got a concept, and they basically still need to prove the concept. And that's about how to enrich isotopes, how to take certain molecules and, bash them with electrons until one neutron falls out, basically, if I simplify it. And then it becomes radioactive, and then you can use it in all kinds of mostly medical applications. But their process has not been proven.
Yeah.
So I would say it's a similar opportunity to Renogen maybe 3 or 4 years ago. And I mean by that, it's pre-revenue. There's a lot of promises. It's very exciting. And if the promises are fulfilled, this could be a big opportunity. If the promises are unfulfilled, this could be a big disappointment.
Yeah, and to your point, it's unproven at this point. I also found a couple of short seller reports, and they were particularly talking around, and this is, to your point, pre-revenue, and very importantly, they haven't yet got anything really commercial onto the market yet, and that's the hugely important point. Jean-Pierre, let's stay with you. Question coming through. I'm looking for some cybersecurity. I think it's going to be a great investment space in the future. I've kind of narrowed it down to CrowdStrike and Palo Alto. Would you ask the panel if I'm heading in the right direction, or if there's perhaps one or two that I should go and do some digging of? Jean-Pierre, certainly cybersecurity is only going to get more important. CrowdStrike kind of showed that to us when they shut down parts of the internet last year, but they are back at highs. Your take on the two?
I like both. Look, they're quite expensive at the moment, but they're expensive relative to reported profits. And the thing about a lot of these cybersecurity companies is once you become a client of theirs, you're probably a client for a very long time.
Yeah.
No one's going to drop their firewalls and drop their cybersecurity defenses. And every year, I promise you, there's going to be a fee increase on your subscription. So it's almost like a Microsoft 365 subscription for those of us who have that. Now, you can't get away with it. Once Microsoft have their claws into you, you are a customer for life. So it's similar with Palo Alto and with CrowdStrike. If there were two other companies I'd add to the list someone could look at, it's Cloudflare. That's a company I also like. And it's Fortinet. That's another one. Again, same story. Very expensive, great companies. So it's a very difficult investment decision to make because you could be paying over the odds if there's some disruption into the business model of these four companies.
Yeah, and I would add, it's not just that they've got you locked in, and I like the 365 example. I think my fee went up 30% this year, and I'm just going to pay it because I'm locked in. They also then keep on bringing new products onto their dashboards. Mark, your thoughts around cybersecurity, CrowdStrike, Palo Alto, any others you perhaps got on your list?
Yeah, no, I can't add anything. But I mainly look at the SA stocks, so I can't add anything there.
Then I'm going to quickly ask you a question coming through. Interested in getting some education stocks, like Stadio, but thinking perhaps more Cura or Advotech. Mark, a preference between Cura or Advotech?
Yeah, we've been buying Cura. I mean, the share price has taken I think it's about a 30% dip this year post their results. Market was getting a bit worried about the learner numbers, which stagnated in this previous reporting period. I think that it was more of a one-off kind of blip, and I think that they will continue to grow learner numbers. They've got a lot of capacity in their high schools, and as the students or the learners roll from grade 8 to grade 9 to grade 10, that will fill up the schools. So you'll see added learner numbers. They can put through 7% fee increases. I mean, it's a very defensive sector. Everybody wants their children to go to get a decent education, and so the parents will do a lot to put their kids through school. So I think you'll see decent double-digit earnings growth, and the management team there is quite focused on driving ROE and dividend returns. So that's my preference. I also like Stadio, but the share price has run quite hard this year. That one's really got some nice growth opportunity. And then Apotech's also nice, but just worried a little bit about the expansion into Africa. They've done very well with it so far, but there is potential for them to make missteps there.
Yeah, but things can go wrong. Jean-Pierre, a lot of questions around Pick n Pay. Of course, we saw their results yesterday. Bunch coming through around Boxer as well. Their results, 10 days ago or so. And of course, Pick n Pay still holds a bunch of them. Does either Pick n Pay or Boxer, or perhaps neither, interest you, Jean-Pierre?
Boxer interests me. I think it's a tale of two cities, these two businesses within the Pick n Pay holding structure, being the Pick n Pay brand and the Boxer brand. And now that I can buy Boxer directly, that's my preference. At the moment, there's a small positive value being attributed to the Pick n Pay business if you buy Pick shares. And they do have positive net cash at the moment on the balance sheet outside of their stake in Boxer. But they are loss-making, and they're going to be loss-making now for at least an additional year. And the top line, I mean, it's an interesting one. If you look at like-for-likes and you look at corporate versus franchisee, and then, the moment you start closing stores, the whole calculation of like-for-like also becomes interesting because you take it out of the base as well. So I think we need a few more data points to really consider whether the turnaround is gaining steam. I'm not seeing any steam yet, and that is why my preference is to buy Boxer shares directly.
Yeah, and as you point out, the turnaround was delayed by a year, or the success of it, and turnarounds are tough. There's just no halfway around that. Mark, Boxer, Pick n Pay, either, both, neither?
Yeah, I mean, I guess there is value in Pick n Pay, but turnaround is uncertain, and the South African macro economy, we're expecting quite a nice strong year, and then with all the tariffs toing and froing, and it looks a little bit weaker than what we expected, so that makes it even more difficult. So I guess if I had to choose between the two, I'd choose Boxer for the growth story and the store rollouts.
Question coming through around CA Sales. I like what their business is. Looking at the stock, it's looking like it's not too expensive. Mark, CA Sales, a very, very small cap. Is it one that's on your radar, one that you've got thoughts on?
No, I haven't looked at it for a very long time.
Yeah, Jean-Pierre?
I've met the management team, and I remember way back it was listed and then it delisted,
yes,
and then it sort of like relisted via the Cape Town Stock Exchange first. And it's a nice little business, distribution of fast-moving consumer goods quite substantially into Africa, Botswana, a few other countries. And they just chug along and do very nicely. So, yeah, it's a solid business. You say it's a small business, but the share price has done very well the last 2 years when it moved to the JSE. So, maybe in a year or two's time, if we speak about it again, it's not that small. So I like the business. Liquidity is relatively low, also given the size of the business. So the value traded is less than some other stocks. And that's why most institutional asset managers wouldn't look at it. It might be a little bit too small for them, but that creates an opportunity for a lot of retail investors, like the ones who watch this show.
Yeah.
So I definitely think it's one that one can have a closer look at and perhaps buy some and put in your bottom drawer as CA Sales becomes a bigger company.
Yeah, I mean, 100%. That stock was what, R6, and now it's almost 20. Although, as you say, volume only 50,000 shares, but that's opportunity for the private client investors. And another question coming through around a theme, and in fact, it's the same viewer who asked the CrowdStrike Palo Alto, ASML or Nvidia. Is this a better place to look for AI, or should I go to some of the AI companies such as perhaps a Microsoft or an Alphabet? Jean-Pierre, your thoughts on AI? It's going to be huge. It's going to be in our future. We know that. The winners might not be so clear. Would you look at sort of the shovels, or would you look at the end companies?
So it's interesting. So ASML make the machines who make the shovels.
Yep.
And Nvidia then make the shiniest shovels at the moment. Being their chips, which are by far and away the best chips, combined with their software, CODA, which effectively allows one to run AI applications on these chips. So between the two, I think selling your shovels is more cyclical. Because if people find a way to dig more effectively, then they need less shovels. While if you make the machines who make the shovels, sometimes those machines don't just make shovels, they just make basically any tool that's used in mining, and therefore I prefer to be a little bit higher up on the value chain. ASML has got less competition. I mean, they are by far and away the only provider who can make the type of machines that can make chips up to the current very infinitesimally small computer chip technology. While Nvidia at the moment is at the forefront, but there are some other GPU companies that are snapping at their heels.
Yeah.
None of them have caught Nvidia yet, but never say never. So between the two, I would probably prefer ASML.
Yeah, and we've got Nvidia results. I think it's aftermarket close in the US tonight, nice. And that'll give us a whole lot more. Mark, we had Pepkor results out today. I had a quick look at them. The market seemed a bit sanguine. What's your thoughts on Pepkor?
We like it a lot. I think the earnings were a little bit softer than the market expected. I mean, there is a high expectation built in for PEP. Also, the Brazilian business, they're kind of a little bit less. It was a difficult trading period for them in Brazil. So, I mean, that is the real kind of blue sky for PEP. If they can get it right in Brazil, I mean, that's serious upside for the company. But I mean, I think double-digit normalized earnings growth, I mean, that is what we expected. And their fintech sales, the handset sales, the financing of the handset still doing extremely well. So yeah, like the business, and also earlier onset of winter this year around is going to help our retailers a lot. Last year, winter sales were not great because we had a very short, I think we were only cold in Joburg for about 2 weeks last year, but this year started early. So I think better sales for the clothing retailers as well.
Yeah, look, for the record, 2 weeks is more than enough cold, and that flash business is quite something. Jean-Pierre, Pepkor?
Yeah, that's exactly what stood out for me as well, Simon, is the whole financial services segment within Pepkor. If you look at the growth on a segmental basis, by far and away the growth has been driven by the financial services segment. So even some of the growth you've seen that's allocated to the retail segment is because of additional sales that are enabled by a slight shift towards credit sales. And you would see the gross profit thereof in the retail segment, but it's enabled by financial services, by credit. So it is becoming clear, if you think about also the furniture acquisition they made, buying those stores from ShopRite, that they want to sort of feed the machine. They want a larger storefront property, more people coming into the front door, but then probably pushing financial services. And that's where the good growth prospects for them are. Because at the moment, retail sales in general, whether it's clothing, whether it's furniture, is pedestrian. So yes, we might get a slight colder winter or earlier winter, but longer term, retail sales, while the consumer is under pressure, is going to struggle to reach double digits. So I like the strategy of Pepkor to say, let's plug in financial services, let's make it as an enabler. They have a lot of opportunity there because it's still by far a cash retailer. And that means that their prospects look bright. At EBITDA, a little bit disappointing. So we need to wait and see if they can fix and get that business into a growth area as well.
Question coming through around Kumba, under 300 Rand, looking cheap over the last 5 years. Certainly, I think it's at 5-year lows. My chart's only a 3-year zoom. It's pretty much at 3-year lows. In fact, it's at 5-year lows. Jean-Pierre, would you be looking at Kumba? I mean, very much a single commodity miner. It is iron ore. We need to see steel demand really for iron ore demand, for Kumba demand. Or is that sort of underthinking it?
No, I think that's it. I would just go one step further to say your steel demand will probably be driven by China and what they do in terms of residential construction. And maybe India can take the baton from China in terms of high imports and usage of steel because of the building of more high rises. But basically, that's the dynamic. So you need to have an eye on India and China and keep the other eye on iron ore, and that would inform your decision on Kumba. I'm not a big fan of Kumba, nor basically any mining company, because they are so reliant on the spot price of the underlying commodity or metal or mineral that they sell. And that's why I normally have quite small exposure to the mining sector.
Yeah, price takers, and of course in South Africa we can add Transnet into that story. Well, for the bulk commodities, the gold miners don't need Transnet. Mark, your thoughts on Kumba Iron Ore?
Yeah, I mean, you are taking a bet on the iron ore price, and we do expect it to be weaker going forward. There's additional supply coming out of Guinea. There's quite a big Chinese-backed project which comes online later in this year. It's going to put more pressure on the iron ore price. The only thing that can really get the iron ore price up is if China decides to stimulate infrastructure or property specifically. And we've seen the President Xi on numerous occasions saying that they want to swing the economy more towards a consumer-driven economy and away from infrastructure-led economy. So we think it's unlikely that they will do that. I mean, the recent memory in 2015 and 2017, they did big Chinese stimulus projects which drove the iron ore price. So I think that is unlikely. And then the other headwind that Kumba has is we've got the strongish rand compared to the dollar. So your costs are in rands, and then your top line is driven by dollar and iron ore. So yeah, I think a little bit difficult for Kumba at this time.
Yeah, and Xi Jinping has said he wants to focus on that consumption, which is, that's not going to do a whole lot for steel. Let's go to stock picks, Mark. Let's start with yours. Mondi.
Yes, I'm picking Mondi. So it's one of the more integrated packaging stocks that you can buy into. They own their own plantations in South Africa. They also generate a lot of their own electricity. So these things kind of protect the business from when wood and pulp costs are rising, or when energy costs are going crazy like it did when Russia invaded Ukraine. But the reason to buy Mondi now is because that they've been busy with expansion projects, and those are starting to come online. So they've invested in additional capacity at their Stetti mill. The Duino plant's coming online, and they bought a business, the Schumacher business in Germany. And all these things are going to start coming through and filtering through to earnings. So I think you're going to get a bit of you will get an additional growth in earnings from the projects coming online. And the margins are not at peak margins, so it is a cyclical business. Margins are compressed at this point. So I think as the new capacity comes online, perhaps you get a better macro environment. Margins can improve on top of that. And all this adds up to a double-digit earnings growth. And at the same time, you earn a 3.5% dividend yield in a well-run business with good prospects.
I actually hadn't realized their dividend yield was quite that high. Nice dividend yield. Jean-Pierre, you found us a stock in Belgium. No surprises. I hadn't heard of it before. What's your stock pick?
Yes, I need to keep it interesting on the show.
No,
I
absolutely.
can't be picking the same stocks every time. So the stock is Melexis, as you said, listed in Brussels. and they are in the semiconductor industry. They sell chips and sensors that go into cars, but this is very high-tech sensors, and a lot of their market share gains the last 2 years have come from China. So as China has gained market share with EVs, electric vehicles, taking market share from internal combustion engine vehicles, the suppliers of sensors and advanced chips to those Chinese vehicles have also done well. And Melexis is one of those. But they still have the base of clients also in the traditional ICE market. So it's been swings and roundabouts where they win on the one side, lose on the other side. And the share price has been under pressure, but the business has actually been stable as you have these two streams going in opposite directions. Growth in China with EVs versus some contraction in Europe in ICEs. So we think as we get through this transition, people will come to realize the stability in the business, very cash generative, high dividend yield, and it's one of the more stable businesses you can find in the semiconductor industry. And yeah, I like it. So Melexis is my stock pick tonight.
Excellent. Yep. We like the ones we haven't heard of before. That's where we will leave things for tonight. Thanks to our guests, Jean-Pierre Verster, Protea Capital Management. Melexis is his pick. Mark Du Toit from Oystercatcher Investments going with Mondi. Up next, the close. Stay tuned.